Hi everyone, welcome back. Now let's continue solving questions for Ind AS 36. Now this question focuses on calculation of value in use. In all the previous illustrations that we did, either value in use was given directly or we were given estimates of future cash flows, and all we did was discount those future cash flows to arrive at the value in use. Over here, we are actually now going to look at how those future cash flows are going to be determined. Remember, value in use is the present value of the expected cash flows to be received from continuing use of the asset. If you continue to use the asset until its end of useful life, then what are the present value of the expected cash flows that are going to be generated from the asset? Now, in calculating the value in use, although I did not mention it specifically earlier, I would like to call it now. Let us say you have a machinery, you're producing inventory using that machinery. Now, when you sell that inventory in the market, you would actually receive proceeds. All right, you'll receive sale proceeds. But remember, you also incur certain cost to produce the inventory. You also incur certain raw material costs, labor costs, and so on to produce the inventory. All right. So when you are estimating value in use, you are not only supposed to take the sale price, but you're also supposed to consider the variable cost that you're incurring. The cost that you're incurring should actually also be considered, and basically you're required to consider sale price less cost as your net inflow. Sale price less cost is going to be the net inflow for you from the particular machinery. So value in use is not going to be just sale proceeds, but it's not going to just be equal to sale proceeds from inventory, but it's going to be sale proceeds less cost of production of the inventory. So the net amount is basically your cash inflow that you expect to generate from the particular machine's use. All right, so remember, the point that I wanted to drive is you're not supposed to just consider cash inflows, but you're supposed to consider cash inflows less cash outflows, and whatever is the net amount that will be discounted to arrive at value in use. So E Limited owns a particular machine which is used in the manufacture of steering wheels. It's used in the manufacture of steering wheels, which is sold directly to car manufacturers. All right, so there is a machine which is used for the purpose of production of steering wheels, and these wheels are sold to the car manufacturers. The machine was purchased on 1st of April 2011 at a cost of rupees 5 lakhs. The machine was purchased on 1st April 2011 at a cost of rupees 5 lakhs through a vendor financing arrangement on which interest is being charged at the rate of 10% per annum. Alright, so I purchased 5 lakh rupees. For this 5 lakh rupees, I did not pay the vendor cash. I had actually purchased it on credit, and the vendor is charging me interest at the rate of 10% per annum. So every year I am required to actually pay interest at the rate of 50,000. I am required to pay interest of 50,000 to the vendor. That is a cash outflow that I'm incurring every year. During the year ended 31st of March 2013, E Limited sold 10,000 steering wheels at a selling price of 190 per wheel. So 2013 year is completed, and in the year ended 2013, E Limited sold 10,000 steels at a selling price of 190 per wheel. The most recent financial budget, which is approved by E Limited's management, covering the period 1st April 2013 to 31st of March 2018. The year ended 31st March 2013 got over. 31st March 2013 got over, and E Limited has prepared financial budget. It has prepared a budget for the next 5 years. Starting from 13 till 2018, it has prepared a financial budget which has been approved by the management, wherein it is stating that the company expects to sell each wheel at rupees 200 from 2013-14. Where in the past, in 12-13, we sold it at 190 per wheel, but in the future, in 2013-14, we expect to sell it at rupees 200. We expect to sell the steering wheel at rupees 200. This price is going to rise in the later years. This 200 is for 13-14, and it is expected to rise in later years in line with the inflation forecast of rupees 3% per annum. So in the year 2013-14, we will be selling it at rupees 200, but in the years later, there's going to be an inflation of 3%, and therefore the price of the product will also, the price of inventory will also increase by 3%. So in the year 13-14, it will be 200. In the year 14-15, it will be 200 multiplied by 1.03, which is equal to 206. So the selling price will increase by 3% every year. All right. During the year ended 31st March 2014, E Limited expects to sell 10,000 steering wheels. In the last year, in the year ended 31st of March 2013, E Limited sold 10,000 units, and in the next year also, in the year 13-14 also, it expects to sell the same number of steering wheels. This number is forecasted to increase by 5% each year until 2018. So next year I sell 10,000 units. In the year 14-15, 13-14, 10,000 units I'm expecting to sell. In the year 14-15, it is expected to rise by 5%, which means I expect to sell 10,500 units. 10,000 is the number of units that I expect to sell in 13-14. That's going to increase by 5%. So 10,500 will be the number of units that I expect to sell in 14-15. That number will keep increasing by 5% until 2018. So in the year after that, it's going to be 10,500 into 1.05. E Limited estimates that each steering wheel costs rupees 160 to manufacture. Each steering wheel costs 160 to manufacture, which includes 110 of variable costs, rupees 30 as fixed overheads, and rupees 20 as transportation costs. They've given a breakdown of variable, fixed, and transport costs. So 160 is the total cost that we are expecting to the total cost per unit for manufacturing. These costs are expected to rise by 1% in 2014-15. These costs are expected to rise by 1% in 14-15 and then by 2% until 2018. All right, so the cost is expected to be 160. This cost is expected to rise by 1% in 2014-15 and by 2% after that. All right, so 160 will become 161.6. All right, because it's going to increase by 1%. 160 in 2013-14 will become 161.6 in 2014-15. After that, it will increase by 2% each year. During 2015-16, the machine is going to be subjected to regular maintenance costs of rupees 50,000. There's going to be some regular repair and maintenance in the year 2015-16 of rupees 50,000. This is a cash outflow for the company that is associated with the machinery. When you're calculating the value in use for the machinery, you will discount all the present value of the cash flows that you expect to receive. 50,000 is a cash outflow, and this will be deducted when we are calculating value in use in 2015-16. In 2013-14, E Limited expects to invest in a new technology which costs rupees 1 lakh. This technology will reduce variable costs of each steering wheel from 110 to rupees 100, and the share of fixed overheads will reduce from 30 to 15. Additional information that's given in the bracket is this is subject to the availability of technology, and this technology is still under development. All right. There is a technology which is under development, and if this technology is successful, if this development is successful, the variable cost will reduce from 110 to 100, and fixed costs will reduce from 30 per unit to 15 per unit. All right, there's going to be a cost savings, but to achieve those cost savings, you'll have to incur a cost of rupees 1 lakh. All right, if you incur a cost of rupees 1 lakh, there's going to be an expected savings of rupees 25, 110 to 100 reduction in variable overheads and 30 to 15 reduction in fixed overheads. So there's going to be a savings of rupees 25 per unit produced. Now, Ind AS 36 states that there are two types of capital expenditure. This is actually a capital expenditure. All right, you're investing in a development which is going to give you benefits in future. So this is a capital expenditure. Ind AS 36 states that there are two types of capital expenditures. Capital expenditures that have been planned but not yet committed to. All right, capital expenditures which are planned but not yet committed to. And the second type is capital expenditures that an entity is committed to. All right, capital expenditures which is planned but not yet committed. Second is capital expenditures which an entity is committed to. Planned but not yet committed to basically means I have a plan to make this capital expenditure, but I'm not obligated to incur the capital expenditure. I may choose not to incur the capital expenditure. I have planned in my forecast, I'm planning that I will incur this expenditure, but I'm not obligated to incur it. I'm not obligated, all right, which means I'm not forced to actually incur that capital expenditure. I may choose, I have a choice to not incur it. I'm just planning, but I have a choice not to incur it. All right, if in such cases, the capital expenditure will not be considered as an outflow for VIU computation. For the purpose of value in use computation, a capital expenditure which is planned but not yet committed to will not be considered as an outflow. It will be disregarded for VIU computations. It won't have any effect for VIU calculation purposes, because the entity is not obligated to incur this cost. All right, it is only in the planning stage and the entity is not obligated to incur. Therefore, Ind AS 36 states that such type of capital expenditures shall not be regarded, shall not be considered for VIU computation. The second type of capital expenditure that we spoke of was capital expenditures that an entity is committed to incur, and capital expenditures that an entity is committed to. These are expenditures which an entity is obligated to. For example, let us say I entered into an agreement for the purpose of acquiring another machinery. All right, I've entered into an agreement for the purpose of acquiring another machinery. That is a capital expenditure that I'm committed to because I've entered into an agreement. So I have an obligation to actually incur such a capital expenditure. Such types of capital expenditure will be considered as an outflow for VIU calculation. For VIU calculation, only capital expenses which are regarded, which an entity is committed to, will be considered as an outflow for VIU. Capital expenditures which an entity is committed to will be considered as an outflow for VIU calculation. In this question, it's only mentioned that the entity expects to invest, all right, which means it's not obligated to, it is planning to invest in this technology. So this is an example of a capital expenditure which is planned but not yet committed to. Therefore, will we consider this as an outflow for VIU calculation? The answer is no. We are not going to consider this as an outflow for VIU calculation. Now, same way, because we are not considering this as an outflow for VIU calculation, because this 1 lakh is not being considered as an outflow for VIU calculation, the cost saving that is coming along with it, the cost savings will also be disregarded. I am not going to take these cost savings into account for VIU computation. I am not going to take these cost savings into VIU computation. I have not taken the 1 lakh outflow for VIU calculation purposes. Similarly, the cost saving will also be disregarded for VIU calculation purposes. I will continue to assume that the costs are actually going to be 110 of variable costs and rupees 30 of fixed overheads. I'm not going to assume that the cost savings will actually come into picture. All right, E Limited is depreciating the machine using straight line method over the machine's 10-year useful life. The machine has a useful life of 10 years. That is what the question has mentioned. We purchased the machinery in 2011 and the machine was actually expected to have a useful life of 10 years. The current estimate based on similar assets that have reached the end of their useful life of disposal, the current estimate of the disposal proceeds from selling the machine is rupees 80,000 net of disposal costs. The entity basically expects to receive 80,000 as residual value. At the end of its useful life, the entity expects to receive rupees 80,000 as expects to receive it as residual value. E Limited expects to dispose of the machine at the end of March 2018. So E Limited is expecting to actually dispose this machine at the end of 2018. So therefore, since E Limited is expected to dispose this machine at the end of 2018, we have cash flows up to 2018. All right, we have cash flows up to 2018 starting from 2013. At the end of 2018, we expect to dispose of this machinery and we expect to receive 80,000 from such disposal. E Limited has determined a pre-tax discount rate of 8%, which reflects the market's assessment of the time value of money and the risk associated with the asset. All right, so the pre-tax discount rate is 8%. Assume a tax rate of 30% and determine the value and use of the machine in accordance with Ind AS 36. Determine the value and use of the machinery in accordance with Ind AS 36. That is the question. All right. Some points let me just highlight. Ind AS 36 states that we are supposed to discount pre-tax cash flows using a pre-tax discount rate. Ind AS 36 states that we are required to discount pre-tax cash flows with pre-tax discount rate. What does pre-tax cash flows mean? When we estimate the cash flows from this machine, we are not going to deduct tax. We were not going to deduct tax. All right, those are called as pre-tax cash flows. All right, these are cash flows before deducting tax. Cash flows before deducting tax will be discounted using a pre-tax discount rate, which means the discount rate is also before giving effect to the reduction of tax. All right. So cash flows are also before deducting tax. Discount rate is also going to be before tax deduction. So pre-tax cash flows with pre-tax discount rate. Therefore, this tax rate of 30% is irrelevant. All right. Even if it was given or whether it was not given, I'm not going to do anything using this. All right. We are not going to deduct taxes for the purpose of computing value in use. All right. So pre-tax cash flows with pre-tax discount rate. That's point number one. Point number two is the question actually mentioned that the company is incurring 50,000 of cash outflow as interest. All right. The company is incurring 50,000 cash outflow as interest because it purchased the machine on a credit basis. Ind AS 36 also states that financing cash flows or interest cash flows should not be deducted for the purpose of computing value in use. For the purpose of computing value in use, cash flows that relate to financing activities or interest cash flows shall not be considered for VIU calculations. All right. This is also in line with your capital budgeting principle. In your capital budgeting also, you never actually deduct interest as an outflow. For the purpose of evaluating NPV, you never deduct interest as an outflow. All right. So similarly over here as well, financing cash flows are not going to be considered as an outflow. All right. We're not going to consider financing cash flows as financing cash outflows for the purpose of considering calculating VIU. So are we going to consider 50,000 as an outflow for the purpose of computing the VIU of this machinery? The answer is no. All right. So we're not going to consider interest expense as an outflow for calculating VIU. All right, so what are we going to do? For VIU, we know that we have to calculate the present value of the expected future cash flows. What are the expected future cash flows over here? I know the number of units that I expect to sell in future. I know that the number of units I'm expected to sell in future. I also know that the selling price I will be charging on a per unit basis. I also know the cost that I will be incurring on a per unit basis in future. Selling price less cost basically represents the profit that I'm going to earn on a per unit basis. So I will take the number of units and multiply that with the profit per unit, and that represents the cash flows that I'm expected to receive. All right, these are the cash flows that I'm expected to receive after deducting any costs. There's also a maintenance expenditure which is given. Maintenance expenditure will be considered as an outflow. Capital expenditure, which is planned, is not going to be considered as an outflow. Interest expense, I told you, will not be considered as an outflow. And we have 80,000 of residual value. 80,000 is an inflow that I expect to receive at the end of March 2018. That will be considered as a cash inflow. 80,000 will be considered as a cash inflow in the last year. And I will be discounting them using a pre-tax discount rate of 8%. I will be discounting it using a pre-tax discount rate of 8%. All right, so let's quickly start by calculating the estimated cash flows that I expect to receive. All right, so I'm not actually plotting years in rows this time. This time I'm plotting it in columns. Reason being, I've got sales, sale price, cost, and all of them to track. So I'm plotting it in columns. I have year one, year two, year three, year four, and year five. Year one is basically going to be 13, 14. Year one will be 13, 14. Year 2 will be 14, 15. Year 3 will be 15, 16. Year 4 will be 16, 17. And year 5 will be 17, 18. All right. On 31st of March 2018, I plan to sell off the asset and therefore I have cash flows only until year 5. All right. Let's start with number of units to be sold. The question mentioned that in the year 1314, I expect to sell 10,000 steering wheels. During the year ended 31st March 2014, E Limited expects to sell 10,000 steering wheels. The entity expects to sell 10,000 units in the next year, in the year 1314, and that is expected to increase by 5% each year until 2018. All right. So the number of units sold, will be 10,000 for the first year. It will increase by 5%, so it will be 10,500 for year 2. That will increase further by 5%. It will increase further by 5%, so it will be 10,500 into 1.05, which is 11,025. That will further increase by 5%, so it will be into 1.05, which is 11,576. And further, that's going to increase by 5%, and that will be 12,155. I'm ignoring decimals because obviously number of units sold cannot be a decimal number. So I expect to sell 10,000 units in the next year. That's going to increase by 5% in year 2, further by 5% in year 3, year 4, and year 5. Next, let's come to selling price per unit. All right, let's come to selling price. The question mentioned that the entity expects to have to sell each unit for 200 during 2013-14. If you focus on this, it says that the entity expects to sell each unit for 200 during 13-14, and the price will be rising in the later years with a forecasted inflation of 3% per annum. All right, so the selling price for year 1 will be 200. The selling price for year 1 will be 200. That's going to increase by 3% every year. So in year 2, it will be 206. 200 into 1.03 will be 206. All right. Further into 1.03 will be 212. All right. It's actually 212.18, but I'm actually rounding because ICAI has also rounded it. All right. Institute has also rounded it, and therefore even I am rounding it. In year 4, it will be 212 into 1.03, which is equal to 219, and then further into 1.03 will be 225. So we start with 200 as the selling price per unit, and that will actually increase by 3% each year. Now, what is the cost of production? All right, let's see what is the total cost of production. The question said that the entity estimates that each steering wheel will cost rupees 160 to manufacture. It will cost rupees 160 to manufacture, and this cost is expected to rise by 1% during 2014-15 and then by 2% during the every 2% per annum until 2017-18. Until 2018 March, it will increase by 2%. So in the first year, it will be 160. The cost will be 160. I'm writing it as within brackets to denote that it is an outflow. It's a cost which represents a negative number, and therefore I'm writing it in the brackets. 160 will increase by 1%. So in the second year, the cost will be 161.6. The cost will basically be 161.6. I did 160 into 1.01. Every year later, it's going to rise by 2%. So later it will be into 1.02, which is equal to 165. In fact, I'm sorry, let me actually not write this in decimals because the institute has not calculated it in decimals. So I'm writing this as 162. All right. So 162 will be the cost for the second year. That will further increase to become 165 in the third year. Into 1.02 is going to be 168 in the fourth year. And further into 1.02 will be 171 in the last year. All right. It will be 171 in the last year. So cost is increasing from 160 and it is going up to 171. All right, so that is the selling price and the cost. Therefore, the profit per unit will be the difference between selling price and cost. All right, so 40 is the profit per unit for year 1. 206 less 162 is going to be 44. Let me just recheck that. Yes, it's going to be 44 in year 2. 212 less 165 is going to be 47. 219 less 168 is equal to 51, and 225 less 171 will be equal to 54. These are the estimated profit per unit. All right. So in each of the future years, I expect to make a profit of 40, 44, 47, 51, and 54 respectively. So let's focus on year 1. I expect to sell 10,000 units and I expect to make a profit of 40 per unit on every unit sold. On every unit sold, I expect to make a profit of 40, and the number of units that I'm expected to sell is 10,000. Therefore, the cash flow that I expect to receive, will be number of units multiplied by the profit per unit, which is equal to 4 lakh in this case, 10,000 multiplied by 40, which is equal to 4 lakh. For the second year, that will be equal to 10,500 into 44, 10,500 into 44, which is equal to 4,62,000. For the third year, it's going to be 11,025 multiplied by 47, which is equal to 5,18,175. For the fourth year, it will be 11,576 multiplied by 51, which is equal to 5,90,376. For the fourth year, it will be 12,155 multiplied by 54. 12,155 multiplied by 54, which is equal to 6,56,370. All right. So these are the cash flows that I expect to receive. 4 lakh in the first year, 462 in the second year, and so on. All right. How did we calculate this cash flow? I projected the number of units that I expect to sell, the selling price per unit, the total cost that I expect to incur per unit. That gives me selling price less cost, gives me profit. Profit multiplied by the number of units sold gives me the expected cash flow. Over and above this, we also had maintenance costs. We had maintenance costs that we were going to incur of rupees 50,000. The maintenance cost was going to be incurred in the year 2015-16. In the year 2015-16, we were going to incur, which means in the year 3, we were going to incur a maintenance cost of rupees 50,000. I'm denoting that as a negative number because that is a cash outflow. Finally, we had residual value, which the entity was expected to receive upon sale of asset at the end of its useful life. We had residual value that an entity was expected to receive at the end of its useful life, which was equal to 80,000. All right, so we are going to write that as a cash inflow for the last year. It's a cash inflow, and therefore I'm denoting it as a positive number only. All right, so finally we have plotted the cash flows, we've plotted the maintenance cost, and we have plotted the residual value. So let's take a sum total of all these three values. Let's take the sum total of all these three values for all the years. That will be the cash flow for VIU purposes. Therefore, cash inflows will finally be equal to, for the first year, it's going to be 4 lakh because there is no other. Let me actually do one thing. Let me write the headings once again. It's going to be year 1, 2, 3, 4, and 5. Year 1 is basically 13, 14. Year 2 is 14, 15. Year 3 is 15, 16, 16, 17, and 17, 18. All right. Year 2 also, we don't have any other cash flow, so it will be equal to 4,62,000. Year 3, we have 5,18,000 less 50,000. 5,18,000 less 50,000, which is going to be equal to 4,68,175. It will be 4,68,175. 518 less 50 is 468,000. Year 4, we don't have anything else, so it will be 590,376. It will be 590,376. Year 5, we have 656 plus 80,000. 656 plus 80 is 736. All right, so we'll have 7,36,370. All right, so these are the net cash inflows that I expect to receive from continuing use of the asset. From the use of the asset for the next 5 years, these are the cash flows that I expect to receive from the asset. All right, now we have to discount these cash flows. All right, remember, these are pre-tax cash flows because I've not deducted tax. I've not deducted tax for estimating these cash flows. Therefore, these cash flows are actually pre-tax cash flows. All right, Ind AS 36 requires entities to use pre-tax cash flows for the purpose of discounting, and the discount rate that we would use is the discount rate of a the discount rate that we would be using is the pre-tax discount rate of 8%. We've been given a discount rate of 8%, so we are going to use the present value factor at 8%. We are going to calculate the present value factor at 8%. All right, so the first year present value factor will be 1 divided by 1.08, which is equal to 0.9259. The second year will be 1 divided by 1.08 the whole square, which is equal to 0.8573. The third year will be 1 divided by 1.08 the whole cube, which is equal to 0.7938. The fourth year will be 1 divided by 1.08 the whole power 4, which is equal to 0.7350. And the fifth year will be 1 divided by 1.08 whole power 5, which is equal to 0.6806. Alright, so we calculated the discount factor as 1 divided by 1 plus r. 1 divided by 1 plus r, the whole power n. Discounted cash flow will be calculated as the product of cash inflow and the present value factor. Discounted cash flow will be calculated as the product of cash inflow and present value factor. So that will be 44 lakhs multiplied by 0.9259 for the first year, which will be equal to, which will be equal to 3,70,360 for year 1. This is the discounted cash flow. 3,70,360 for year 1, 462 multiplied by 0.8573, which is equal to 396,073 for year 2. 468,175 multiplied by 0.7938, which is equal to 3,71,637 for year 3. 590,376 multiplied by 0.735, which is equal to 4,33,926 for year 4. And for the last year, it will be 736,370 multiplied by 0.6806, which is equal to 5,01,173. All right, so these are the discounted cash flows for each individual year. It's for year 1, year 2, year 3, year 4, and year 5. The value in use is going to be the sum of all these discounted cash flows. The value in use is equal to the aggregate of discounted cash flows, which will be equal to rupees 370,360 plus 396,073 plus 371,637 plus 433,926 plus 501,173, which is equal to rupees 20,73,169. So the value in use, which is the present value of the future cash inflows expected from the continuing use of this asset, is going to be equal to 20,73,169. It's going to be 20,73,169. So the main principles that we learned is one, the expected cash flows are going to be calculated as sales proceeds less any cost that we are going to incur for the purpose of production of inventory. Sale proceeds less cost. That we would multiply it with this number of units sold to calculate the expected cash flows. Any repair and maintenance expenditure will be considered as an outflow. 50,000, we considered that as an outflow for 2015-16. Residual value will be considered as a cash inflow for the purpose of calculating value in use. Residual value, which you expect to receive at the end of the useful life of an asset, will be considered as a cash inflow. Things that items that are not going to be considered as cash flows is one, financing cash flows like interest expense. We did not consider it as an outflow. Tax outflows are also not going to be considered because we use a pre-tax discount rate. We're not deducting tax because we're actually using a pre-tax discount rate for the purpose of calculating present value. So tax is not going to be deducted for the purpose of calculating future cash flows. Also, capital expenditure which an entity has planned but not yet committed to will not be considered as an outflow. We did not consider 1 lakh as an outflow. Correspondingly, we also ignored the benefit that we expect to receive from that outflow. The variable cost would have been a lower value, but we disregarded that variable cost. If actually this was a committed capital expenditure, if this capital expenditure was a committed capital expenditure, I'm just telling you that the answer of the question is over, but I'm now creating a hypothetical scenario of what if this capital expenditure was actually committed. The change would be in 13-14, I would have considered an outflow of 1 lakh rupees. In 13-14, I would have considered an outflow of 1 lakh rupees and I would have correspondingly reduced the cost of production. I would have reduced this cost of production because there would have been a savings of rupees 25. Variable overheads would have reduced by 10, fixed overheads would have reduced by 15. Therefore, there would have been a savings of rupees 25. So I would have considered a cash outflow of 1 lakh rupees in 13-14 and I would have considered a lower cost of production. Lower cost of production will increase the profit per unit. All right. Lower cost of production will increase the profit per unit and therefore is a benefit to me. All right. So if it was a committed capital expenditure, we would have considered both the cash outflow as well as the benefit on account of savings in cost. All right. Pre-tax discount rate, we've already discussed that we use pre-tax cash flows and pre-tax discount rate for the purpose of calculating present value. All right, just with that, we're done with question number 12 and a very exhaustive question on how to calculate value in use. Incidentally, I also want to discuss about the discount rate. We've actually spoken that the discount rate is supposed to be a pre-tax discount rate. All right, what Ind AS 36 also states is the discount rate usually, if you come out of Ind AS 36, outside discount rate is supposed to reflect two things. One is the risk-free rate and two is the risk involved in a particular asset. All right, risk-free rate plus the risk premium. This is generally going to be equal to the discount rate. Discount rate is RF plus the risk premium. All right. In Ind AS 36 also, the standard actually says the same thing, that the discount rate is supposed to reflect two things. The time value of money, which is nothing but the risk-free rate, and two, the risk which is associated with the asset. All right. For example, for equity securities, you use the CAPM formula. All right. If you know what CAPM is, then great. You use the CAPM formula where you're actually calculating the risk premium for an equity asset. All right. Over here, the asset is actually plant and machinery. All right. So you actually take risk-free rate and the risk associated with this plant and machinery. Every asset has got a risk of its own type. Like for this plant and machinery, the risk is basically what if you're not able to produce 10,000 units? What if you're not able to produce and sell 10,000 units? You estimated to sell 10,000 units, but there's a chance that you may not actually sell 10,000 units. All right. So the risk associated with that asset should actually be embedded in the discount rate. All right. The fact that you are not going to certainly sell 10,000, that is nothing but the risk involved over here. And the discount rate is supposed to reflect risk-free rate plus the risk which is associated with the asset. All right, there's no separate question where this is being tested, but since the fact is mentioned in this question, I thought I will actually communicate the same with you. All right, there's a chance that you may not have actually understood this if you have not done AFM, but just remember at the background that under in AFM as well as over here, what we are considering is risk-free rate plus a certain risk premium based on the riskiness of the asset. With that, we're done with question number 12 and any associated points. Let's meet in the next lecture. Thank you.